Hi everyone. In today's video, I'm going to be talking about the relationship between internal liquidity and external liquidity and how we can use these two concepts in order to frame high probability trades. So jumping straight in, external range liquidity is every single swing high and every single swing low. In this example, we have a bullish uptrend, so every single swing low and swing high will be external range liquidity. In the same way, if we have a bearish trend, here we have a swing low, that swing low is my external range liquidity, and here we have a swing high. That swing high is also my external range liquidity. And in this video, I'm going to show you how we can use external range liquidities to our advantage to frame high probability trades. And I'll also show you what you need in the lower time frame in order to take a trade. So I'm going to run over the exact lower time frame entry confirmation list that you need to check off before you take any trade. So this can be a complete model in its own. You can also use these two concepts, external and internal range liquidity, and add them to your trading toolbox to potentially increase your win rate. So here we can see we have taken out external range liquidity. After price action takes out external range liquidity, we are very likely to seek internal range liquidity. Now, what is internal range liquidity? An internal range liquidity is any fair value gap that we have in this displacement leg that took out external. So if we take out this external high, I'm not going to look for internal range liquidities here, because which leg of price action took out this high? It is this current displacement leg. And in this example, here we've taken out external low. So where are we going to look for internal fair value gaps? We are not going to look for internal fair value gaps here, because this leg of price action took out this swing low. So we are going to be looking for internal fair value gaps in this displacement leg. Now, if you do not know what a fair value gap is, I'm going to briefly explain it in this video, but I do have a dedicated video on fair value gaps that you are more than welcome to look at. Now, again, we have swept external, we are looking for internal range liquidity. Here we have swept external, we are looking for internal range liquidity. If price action comes and we take out this external low, where are we going to be looking for internal range liquidity? We are going to look for fair value gaps in this leg of price, because this leg of price swept our low. So we are going to look for fair value gaps in this leg of price. In the same way, if price action comes up all the way and takes out this high, where are we going to look for internal fair value gaps? We're going to look for internal fair value gaps in this leg of price action, because this was the displacement leg that took out the high. So I'm briefly going to explain what a fair value gap is in this video. Like I've mentioned, I do have a dedicated fair value gap video where I discuss all the nits and grits of a fair value gap. And so this is just going to be a quick rundown. A fair value gap is a 3-candle pattern where we have candle number 1, we have candle number 2, and we have candle number 3. So candle number 3, the bottom wick in a bullish scenario does not touch the top wick of candle number 1. Now here you can see that we have this overlap. They do not overlap. So we have this gap in price. This is known as a fair value gap. Here we have our fair value gap, and here we have a bearish scenario. Here we have candle number 1, candle number 2, and candle number 3. And we can see the low of candle 1 does not touch the high of candle 2. That leaves this gap in price. That is our fair value gap. This can also be a bearish candle. As long as the bottom wick does not touch the top wick, we still have a bullish fair value gap. In the same way, this can also be a bullish candle where as long as the top wick does not touch the bottom wick of this candle number 1. That is still a fair value gap. Now that you understand external range liquidity as every single swing high and swing low, and you understand internal range liquidity, that is our fair value gaps, that will be in the displacement leg that took out that high and low, let's discuss a change in the state of delivery. Because we are going to use a change in state of delivery, or a CISD, to confirm the lower time frame shift in momentum. So we're going to confirm this market from a bearish environment to a bullish environment by the use of a change in the state of delivery. Now, after I discuss change in state of delivery, I'm going to discuss actual time frame alignment and how do we pair the two time frames together to get a high probability trade. So, change in state of delivery. What is it? A change in state of delivery is just the formation of an order block. Remember, an order block is when we sweep out a low with consecutive down close candles or a single down close candle. As soon as these down close candles get closed above, that becomes my bullish order block. So that is also known as a change in the state of delivery. In this example, we have a bearish example. Here you can see this high took out this external high as a liquidity raid. Now here we have consecutive up close candles. As soon as price action comes and closes below these up close candles, has to close below, that forms this bearish order block. That is also known as a change in the state of delivery. So we are going to use change in state of delivery in order to confirm bias and also take an entry off of. Here we have everything we need in a rule-based form. Now, first of all, we need a higher time frame, external or internal pull to get taken, to get swept. When that happens, we drop to our lower time frames, and here we have our time frame alignment, but we'll get there. So after the higher time frame gets taken, external or internal, we go and we look for a kill zone. Remember, this is New York time. London kill zone from 2 a.m. to 5 a.m. New York kill zone from 7 a.m. to 10 a.m. Do not trade Asia kill zone with this model. Now, these are New York times, UTC minus 5. So after the higher time frame gets taken, we wait for New York kill zone or London kill zone to open, and then we drop to the lower time frame and we look for our change in the state of delivery. When we get our change in the state of delivery, we take an entry on the retest of this order block, and stop loss goes at the low, and we target a 2R for the trade. Now, here we have our time frame alignment. This is extremely important, and I want you to write this down. If we are looking at the higher time frame on the weekly, our lower time frame will be the 4 hour. So here we have our higher time frames, here we have our lower time frames. Now this comes down to personal preference. If you are a position trader, I want you to focus on the top pair. If you are a swing trader, I want you to focus on these two pairs. Normally swing traders will use the daily and the 1 hour pairing. If you are a day trader and a scalper, I want you to focus on these two pairs. I personally love trading the 1 hour and the 5 minute, but it is up to you to decide as the trader. Remember, every single trader is different. Now, moving on to real examples. Here we are on NASDAQ or NQ. NASDAQ and NQ's got exactly the same price action. Now on the daily time frame. So every single time I want you, when you get to a chart, I want you to mark out the closest swing low. Here we have our closest swing low to where price action is currently. And I want you to mark out the closest swing high to where price action is currently. Now what I want you to do is either wait for the low or the high to get taken. So if we go down and we take out the low, we are looking for bullish trades back into internal range liquidity. If we go ahead and we take out the high, we are looking for bearish trades back into internal range liquidity. Now let's play this forward to see what happens. Here we form another swing low, so we can go ahead and mark out that swing low, and let's see how price action plays along. Now we can see we've taken out this low, and we have taken out this low, and we have taken out this low here. So price action has run into sell side liquidity. Now what I want you to do is I want you to look for internal range liquidity. Remember, we are only looking for internal range liquidity in this leg of price action. So zooming in, you can see we do have a very small fair value gap here. That is my internal range liquidity. So here we have our target. Now we're dropping to from the daily, we go to the 1 hour time frame, and we are going to look for our entry sequence. Here we have our swing low taken, so I'm just going to mark that as external raid. Now here we have our internal range liquidity, which will be my higher time frame target. Now we are looking for a change in the state of delivery. Here we have 1, 2, 3, 4 consecutive down close candles. So as soon as we close above the opening price, that becomes my valid change in the state of delivery. So either price action trades up and we get a change in the state of delivery, or we go down, sweep the low, and it resets. Let's see what happens. Here we can see we have swept out the low, so my change in the state of delivery moves down. Now, where is my order block? We have 1, 2, 3, 4 consecutive bearish candles. That becomes my new change in the state of delivery. Let's see how price action reacts. We continue lower, so my change in the state of delivery point moves lower to these 3 consecutive down close candles. As soon as we close above the opening price, that becomes my new change in the state of delivery. Have we closed above? Yes, we have closed above with this current candle. So now remember the entry sequence. We have an external rate on liquidity. We have an internal liquidity that we are using as a draw on liquidity, meaning this is my higher time frame target. Remember, this little gray box is my higher time frame daily fair value gap. So we have external rate. We are on the 1 hour time frame, and we have a change in the state of delivery. Do we need a kill zone? That is the second step. Do we need a kill zone? If you enter, and this is very important, if you enter on a time frame that's lower than the 1 hour time frame, kill zones do apply to you. If you take an entry on a time frame that's higher than the 1 hour time frame, kill zones don't apply to you. Here we are entering on the 1 hour time frame, so we can take an entry whenever. We don't need to wait for a kill zone. We take our target, our entry at the retest of this change in state of delivery of this order block. Stop loss goes at the low, and we can target an initial target of 2R, and we can leave a small runner running until we've hit our draw on liquidity. Let's see how this trade plays out. Here we go, and we tap our order block, so we are in our trade. Now we just let this thing play out. We leave price action alone, and we shoot up. We hit 2R, and eventually we go ahead and we hit our internal range liquidity. If you have held this trade, you would have profited a 2.4R on this trade. So this was an example of using external and then chasing internal. Let me show you an example of using internal and then chasing external. Here we are on NQ or Nasdaq on the 1 hour time frame. And so if we are using the 1 hour time frame as our higher time frame, we should be using the 5-minute time frame as our lower time frame. Meaning the 5-minute time frame will be our entry time frame, and we need to wait for kill zones to happen. We can only take trades within a kill zone. So let's analyze price at the moment. We have taken out a swing high, and so we have taken out external liquidity. We are busy seeking internal liquidity. So we can mark out internal range liquidities. Here we have our internal liquidity. Here we have a fair value gap. I'm just going to mark that as our fair value gap. So we are just waiting for price action to trade down lower into this fair value gap. And here we can see we do trade into that fair value gap. So what are we doing now? Remember, we go from external back to internal, and then internal back up to external liquidity. Now here we have taken out internal. So where is our draw on liquidity? It is going to be this high. That is going to be our draw on liquidity. Making that my little magnet. That is my draw on liquidity. So let's drop to the 5-minute time frame to see if we do get that lower time frame entry criteria. So here we are on the lower time frame, and we can see that we have that 1 hour fair value gap here. We have that 1 hour high, which is my external, and I use that as my draw on liquidity. And here we can see we have the sessions that's printed. Here we have Asia session, here we have London kill zone, and we are about to enter New York kill zone as well. So if you're looking for this indicator, it's called FXN Asian session range. Let's get back to the video. Now, what are we looking for in the lower time frame? First of all, we have to wait for the New York kill zone to open. New York kill zone opens 7 a.m., which is the next candle. So we will be in kill zone. Now, what are we waiting for? We have swept internal range liquidity, and we need that lower time frame change in the state of delivery. Remember, we have 1, 2, 3 consecutive down close candles that also took out a liquidity pool. As soon as we close above these down close candles, that becomes my valid change in the state of delivery. So we are just waiting for price action to close above and form this order block. Let's see what happens. The next candle opens, and that's the open of New York kill zone. So we are within a kill zone. Here we can see my kill zone gray box starts printing. Now we're just waiting for price action to close above the change in state of delivery. Do we close above? Yes, we do. Now, what do we need now? Now we just go ahead and enter on a retest of that change in state of delivery. We place our stop loss at the low, and we target a 2R. That's it. That is how easy this can be. Remember, we are going from external back down to internal, and we are chasing external again. So now here we have the 5-minute time frame aligning with our 1 hour time frame. Now we just play this ahead to see how price action plays out. Here we get a tap of our trade, and we just let this position run. Price action runs up to hit my 2R. Let's see if we can hit our long-term draw on liquidity, which will be a total of 3.04R. And here we go. Price action has hit my external range liquidity, and so now we can go back to the 1 hour time frame, and we can rinse and repeat. So removing that, we have taken out external range liquidity. Do we have internal? Yes, we do. Internal is over here. Here we have a fair value gap, so we can potentially look for a trade back to that fair value gap. Dropping back to the lower time frame, are we in a kill zone? No, we are not. The kill zone ended here, so we cannot take this trade. If you're looking to trade alongside and live with me every single day, go ahead and check out the mentorship link in the description. We are running a 20% off lifetime special at the moment, and you will have access to all of my trades. Here you can see I share all my trades. We had a 6-hour day. I share the trades before and after, and I also take losses. Here we took an L yesterday, and we have 2 trades. We have EURUSD that hit take profit, and here you can see the team following along with me nicely. EUTP, EUTP, TP, 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 same thing. And here we have a member that's passed their first phase of their account. So if you are ready to take your trading to that next level, I do recommend signing up for the mentorship program. It is not just a course, it is a complete step-by-step mentorship guide where I walk with you every single day of your trading journey. And I help you become the trader that you've always dreamed of. This is so easy, you just need the right guidance. Guys, I hope you enjoyed today's video, and I will see you in the next one.